And we will wrap up this special edition. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, and our focus on this video is going to be on the earnings front. The company on our radar is Inox Wind that has recently posted its Q2 earnings. The consolidated net loss for the company narrowed to 26.8 crores in the September quarter due to higher revenues. The consolidated net loss of the company also stood at 133 odd crore rupees in the year-old period. As per the BSE filing, the total income from operations has risen to 384 odd crore rupees from 111 crore rupees in the same period a year ago as well. And now to detail for us the key insights from the earnings and the vision going forward is the company's whole-time director, Devansh Jain, now joins in to discuss all of this and much more. Mr. Jain, good afternoon and thank you so much for taking the time out for this discussion. You know, we would be very interested in understanding more insights about the earnings that you have posted, plus the news flow around the commissioning of the latest project, and all of it will be very interesting for all our viewers. But first up, for a larger base of our viewers, if you could please help us really understand, you know, when I was going through your press release, we saw that, you know, in your renewable space itself, you have three companies. One is Inox Wind, one is Inox Green Energy, and the third one is Inox Wind Energy. And all three entities are also separate listed entities as well. So for all the shareholders, prospective investors at large, could you explain what is the difference between all of these three companies and how does a shareholder really decide which company should one invest in?
Hi, good afternoon, Sakshi. Thanks for having me on the show. So to begin with, the three entities are Inox Wind Energy Limited, which is the holding company of our wind business. The main operating company is Inox Wind Limited. Now, at the group level, we had built various businesses under our erstwhile chemicals companies, cinemas, and so on and so forth.
Yes.
Once these companies had become fairly large and sizable, we kind of decided to demerge them because there was no point having a holding company kind of a conglomerate discount at the parent level. So when we did that, as a consequence of that, Inox Wind Energy got created because it was demerged out of Gujarat Fluorochemicals Limited. And that's basically the holding company of Inox Wind. What we've also done about 4 to 5 months ago, which is in the public domain, we've announced the merger of Inox Wind Energy Limited with Inox Wind, so that we just have one listed pure vanilla operating company as opposed to having a holding company as well. So that's already in the public domain. The merger ratios, all the approvals are in place. We're basically waiting for the BSE and the NSE approval. Once we get that, we simply file that at NCLT, and then it's an administrative process to get that done and over with, because we've got all our banking approvals and all our creditor approvals in place. Okay. Coming to Inox Green, that's a subsidiary of Inox Wind. Inox Wind owns 61% of that company. That's basically a plain vanilla O&M company. So again, it's an operating company, but it's a very long-term annuity business, no debt, very, very stable margins. We typically operate about 50% EBIT margins in that company. We listed that last year because we feel that there's a huge opportunity to aggregate a lot of the O&M contracts in the Indian market, particularly given the fact that over the past 6 years, we've seen almost 30 players shut down or go bust in the wind energy sector. The past 5 or 6 years, as you may be aware, was a very painful transition from a feed-in tariff regime to an auctions regime. And now we are really down to 2 or 3 very strong players in the market who survived. So what's also happened as a result of that, you've seen almost 9 to 10 gigawatts of O&M contracts out there, which are really being serviced by unorganized players. So, if I may say so, and it's really the retail, mom and pop kind of people who are servicing these guys. And what we're trying to really do is go out and acquire a lot of this play. So distinct kind of investors. Inox Wind is a long, obviously is a capital goods, power sector, renewable energy play. Very, very high growth over the next couple of quarters. Very, very strong profitability as we keep moving forward. And Inox Green is kind of an annuity pension fund play, Innovate kind of a play, if I may say so, very stable margins, growing. But yes, I mean, so it kind of attracts different players. And also listing it separately gave us the means and the wherewithals to kind of use that as an equity to acquire a lot of the unorganized players. So we've acquired one company, a mix of cash and equity. We're in talks with multiple players, the unorganized players, as well as a lot of IPPs were in touch with us now to kind of merge into this platform. So I think I don't want to give out details, but I think we should be seeing a lot of action on that entity as well.
Wonderful. So thanks for setting that context right for all our viewers out there and differentiating for them as to which company does what really and how does one really go forward with what one aims to achieve with becoming a shareholder in one of or all of these entities too. But let's now come to the numbers as well, Mr. Jain. What really contributed to your numbers this time around? What helped you cut losses? By when do you see net profits on a net basis as well going forward, sir?
I don't think there's any rocket science, Sakshi. I think fact of the matter was when the sector was shut, obviously there was no revenue, right? So if you have no revenue and you are paying fixed costs and you have absurd debt which had been piled up and banking charges were absolutely obnoxious, that was what was leading to the continuous losses. I think where we are today, obviously the sector is on a massive upswing. There's a larger 500 gigawatt plan, which is in the public domain. Our Honorable Prime Minister Modi ji has clearly set out a huge vision. And I think rather than spending too much time on that, fact of the matter is, from an Inox Wind perspective, we're now moving to massively increasing supplies. If you look at the last year, we were broadly at about 100 odd crores. We've now moved up to about 350 odd crores. So, it's a 250% jump. But I think what I've also said publicly is every quarter should just keep getting bigger and bigger for the next couple of quarters. Obviously, in perpetuity, it can't be there. But I think we're on a massive ramp-up mode. I think Q3 will be far bigger than Q2, and God willing, Q4 will be far bigger than Q3. Having said that, we've recently raised 800 odd crores equity. Over the past quarter, we've raised almost 1,300 crores of equity, which is all gone towards paying off debt. And to that extent, you're seeing a significant downsizing of our interest costs. I think what we're also doing as management or as a group, we're renegotiating all our charges with banks. And to be honest, over these 5 or 6 years, if I may be candid, banks have virtually looted us with absurd charges. And I think as a group, we are coming down very, very strongly on that. We are not taking any nonsense anymore. We are removing bankers from the system, if I may say so. We need absolutely normalized charges. What people need to also appreciate, and I think the banking community is very clearly, is as Inox Wind, we've not given a single rupee of haircut to any banker. Unlike many of our competitors and wind players, every banker has been paid every single paisa and with absurd charges. Every creditor has been paid off every rupee with absurd interest, absurd charges. So it's high time people recognize our might. And obviously, not just the group, Inox Wind itself is very, very strong. But obviously now we're using the group might as well to get back to very, very normalized levels. And I think as that comes in, what's also in the public domain, Sakshi, is we've said this year we are going to be in net profit. Naturally, being a listed company, I can't say whether Q3, Q4, but yes, we're very, very clearly on track to get to our net profit number in this financial year.
Okay, fair enough. The stock of Inox Wind also reacted pretty sharply yesterday with the news flow that your customer NTPC REL has now announced the successful commissioning of the first part of the capacity of 50 megawatt of the 150 megawatt Dayapar wind energy project phase 1 in Gujarat. And tell us, with this commissioning, what can be the incremental benefit that you are hoping to see on your financials, sir?
It's an ongoing process. Supplying turbines, commissioning turbines is part of our is part of what Inox Wind does. What this enables us to do is, and the relevance of that was this was NTPC REL's first ever project. It was also the first ever project in India to be declared commissioned under the new stringent IEGC guidelines and the GNA guidelines. It's taken a hell of a long time to get compliant. We had to go through a lot of rigors with PGCIL, with CEA. Obviously, initial things, as more and more renewables comes in, you have more stringent requirements. But happy to say we were the first ever project
Yeah.
to comply with all of these requirements. From a operating perspective, obviously, I mean, what that does to Inox Wind is now we start getting our commissioning revenues. We have certain revenues or cash flows which kick in as we commission turbines. What it also does is, from Inox Green perspective, as turbines get commissioned, they move into the O&M regime. And these
Yeah.
are, 20, 25-year contracts where Inox Green now makes, annuity revenues with very, very strong profitability. So I think that's what this signifies. Naturally, we are a very, very strong partner to NTPC. We're doing about 500 megawatts for them across three projects, across our 2 megawatt platform and our 3.3 megawatt platform. So it's a very strong relationship. And yes, obviously we are diversifying the relationship, but I think it's a great relationship between us and NTPC.
So, of the 500 megawatts that you're looking to commission for NTPC, how are we looking at that spread out incrementally in the quarters to follow, sir?
I think over the next 18 months, that entire piece should be supplied and commissioned.
Okay, got that. What is your current order book stands at? And if you could tell us about the execution as well so far.
So our current order book is at about 1,300 odd megawatts. In H1, we've done about 150 odd megawatts. We've ramped up significantly. So if you look at the previous year's period, this possibly would have been, I don't have the exact numbers, but possibly about 30 megawatts. We've now moved to 150 megawatts. Obviously, Q2 was bigger than Q1, and Q2 being peak monsoon period, I think H2 should be far larger than H1.
Okay.
And I think possibly doubling of H1. What we've also set out in the public domain, we intend to do 500 megawatts in this financial year, and I think we're confident and well on track to be able to achieve that.
500 megawatts. Okay, great. Tell us about, where is the larger part of the pipeline really coming from? Is it from the private players or is it largely from the government side?
I think we have a very large order book from the PSU side tenders which we won. I think what we're now doing is with our 3.3, we're spreading it. To be honest, I think our initial focus was PSUs. I think when the sector is coming out of so much pain, it was important for us to have very credible, long-term people who have the ability to pay. I think we are focused on ease of business and the ability for people to pay. I think what we are now doing, we're diversifying the order book across private sector IPP, C&I players, retail consumers, as well as PSUs. Broadly, I think going forward, maybe I would say about 40% of our business would be PSUs, and about 60% would be across IPP, C&I, and retail customers.
Fair enough, sir. Also, like you briefly mentioned, and I wanted to take that point forward from your earlier answer where you talked about, raising, funds via equity stake sale. After the recent stake sale, the promoter holding, tell me if I'm wrong, if it's around 55% now with the large block deal that we saw, a few days ago. What is the plan further? Are you looking at further stake sale? Is it going to be at this level? What is the entire plan, sir?
You're right. So our promoter stake sale at this point in time is close to 55%. We've said this. We have no intention to dilute stake or raise capital any further. I mean, what's in the public domain was, as of 30th September, our net debt was about 1,200 odd crores. We've raised 800, which primarily goes towards paying debt. So broadly speaking, if I may say so, we're broadly at about 400 odd. And I think we have very, very clear visibility of tremendous free cash flows as we keep moving forward and profitability that we don't need to dilute anything. Also, if you may recall, over the past 12 months, we've gone from 2,800 odd crores of interest-bearing instruments to now about 400 odd crores. So, frankly, we are very, very strong. We see absolutely no further dilution taking place in this entity.
And are you looking at further cutting down this debt to net zero, or are you comfortable with this level?
Oh, no, naturally, obviously, with internal accruals and profitability, this will become zero. I think what we also set out publicly in Q1, we said over the next 12 to 15 months, we intend to become net debt free. I think we've just finished Q2 and we've cut down 1,200 to virtually 400. So frankly speaking, I think we are very well on track, and I think we should be net debt free way before the publicly stated goal.
All right. Well, fair enough. Many thanks, Mr. Jain, for being with us on the show and discussing all these wonderful insights with all our viewers, helping them understand more about the business outlook, also going forward, the financial details. All the very best to you for the upcoming quarters, and here's hoping for more interactions going forward too. Many thanks.
Thank you, Sakshi.
All right, and with that, we will wrap up this special edition. Management sounding very, very confident of definitely going net debt free over the next few months or quarters, and way before the publicly talked about time as well. Largely led by the internal accruals, promoter stake, no need for further dilution from 55% their odds, and 40% of the business and the order pipeline likely to be from the PSU base going forward from here as well. So that's as far as some of the key details are concerned. Do stay tuned onto Business Today Television to catch all the updates from the world of business and stock markets, because this is where you actually get to hear from the top experts, from the top management, to what exactly is happening in the world of stock markets.
which over the next 6 months, 1 year might give stellar returns on the long side.